we're going to have a real economic contraction. We're going to be in the teeth of a very tough recession, and that makes everything much more intense.
There's actually big trouble. There's something really weird happening in the economy, and we need to talk about it. And in this video, we're also going to talk specifically about what might be causing it, because it is a weird dilemma that hasn't happened before, and it's leading a lot of people to say, is this time different? But is that different maybe really bad for certain companies? In this video, we're going to break it all down because it's concerning, and it's coupon expiration day, and I got like 3 flights to hop on today, so it's gonna be a long day of replying to your bundle coupon emails over at staff@meetkevin.com, where you can bundle up if you'd like. Courses on building your wealth. Price goes up after today, especially as we get into the house hack fundraise, and of course, licensed financial advice at stackhack.com will also be going up in price. Link down below. Okay, look, so Dollar General just reported a disaster this morning. Their stock's down like 16.5%. They are expecting to take another $100 million in annual shrink impact. In other words, theft. Things are so bad, people are just stealing more from the dollar store. That's how bad it is. People are stealing from the dollar store. And their sales continue to hit a wall throughout August, even though they weren't even reporting the August quarter. They were just answering commentary about August in their earnings call. And now they actually got downgraded from JP Morgan after such a bad result. This kind of aligns with what Capital One and Amex told us about small businesses and individual consumers somewhat hitting a wall in the summer. Capital One talked about it, Target talked about it, Best Buy talked about it, Home Depot talked about it. I think I hate to say it, but it's somewhat becoming ubiquitous that consumers are substantially experiencing pain. Combine this with what we're seeing with, okay, great, we got our PCE numbers today. Personal incomes fell to 0.2% on the month gains. So yes, personal incomes went up, but very low, less than expected. The personal savings rate fell back into the threes, back to just 3.5%, which is paltry. I mean, we saved more money in 2009 and 10 coming out of the recession of 2008 than we're saving right now. And we like to call it super core inflation, came in actually at the highest level since January. That's no bueno, by the way, okay? Highest level since January means a 0.46% read. Now, of course, some Fed watchers are saying, well, that was really driven by portfolio management. So now people are looking at what they call the super duper core inflation, which takes out portfolio management, which could be a little bit more volatile, and then inflation is only 0.25%. At the same time, we continue to get jobless claims or jobs added numbers that get revised worse over time, leading a lot of people to say, we've got some serious problems. So the question then is, why could the stock market be doing so well, and what else could be causing massive potential issues? Well, we have a fantastic piece from Société Générale, the Frenchies, okay? And they're gonna give us a really interesting take on this. Listen to this. History shows that economists do actually predict recessions, but the problem is they end up giving up on their recession forecasts right before the recession arrives. It's kind of like the bus stop dilemma, where you wait for a bus and you're like, this is taking way longer than I expected, so you start walking to your destination, and basically as soon as you start walking to your destination, but you're too far away to walk back to the bus stop, the bus shows up. So the recession shows up after you've already U-turned, and okay, maybe we won't have a recession. Well, the reason they suggest this is because when you look outside the mega cap tech companies, there's actually big trouble. They mention it. In fact, they say that usually the US corporate sector is a massive borrower, borrowing money and living off of debt. We already know we're in a pretty big debt bubble. Now, I personally don't believe this is the cycle where our debt bubble collapses. This is why I'm more bullish than I am bearish, this obviously being concerning news. But I don't believe that this is the cycle that we actually go through the real big great reset that will come in the future. The de-dollarization will come in the future. But we've got other problems right now. And those other problems are in part broken down by Société Générale. So what they say is that if you look at the total interest expense of companies, you're actually going to expect that the interest expense of companies is going to go up as rates go up. But that's not actually what happened. In aggregate, that is all companies together, interest expense didn't really go up at all. In fact, it went down. Now, this is super counterintuitive. Why, when the Fed funds rate goes up, the blue line here, would you have the red line, net interest payments, go down? All while at the same time, you're finding more bankruptcies happening. S&P reports 402 corporate bankruptcies so far this year, nearly on par with the 407 seen in the pandemic of 2020 and only surpassed by the great global financial crisis. Okay, so what's actually happening? Well, their argument is the following. They basically say, and I translate it here on the left, and I wrote LOL WTF. Remember the whole inverted yield curve? Okay, inverted yield curve means short-term deposits are paying higher yields than long-term loans. In other words, because of the inverted yield curve, the richest companies, think the Apples, the Facebooks, the Amazons, the Microsoft, the Teslas, the richest companies are able to borrow at 10, 20, 30-year debt at cheaper rates than they're able to make on their cash deposits. Think about that for a moment. You could literally be Apple and be like, hey, we've got $100 million in cash. Let's invest it at 5% treasury bills or somehow get it into money markets where we're earning 5 to 6%. And then let's borrow that $100 million back on a 10-year basis. Well, wait a minute. The 10-year is only charging us about 4%. So we're getting charged 4% on the 10-year. We're paying for that interest on the 10-year with money market money that we're getting at 5 to 6%. So in other words, you're literally getting paid, if you have a really good corporate credit score like the big companies do, you're literally getting paid to borrow long and deposit short. It is like the total perversion of the yield curve. Usually you get an inversion of the yield curve because all of a sudden people are like, oh crap, a recession's coming, we've got mass layoffs coming, everything's about to hit the fan. And that could still happen, but this is a massive perversion of what you would expect. In fact, they literally write, interest rates simply aren't working as they once did. This is very strange. So then what they do is they say the largest 10% of companies do not care about interest rate increases. The largest 10% of companies, if you look at the S&P 500, for example, so what they do is they put a chart up here of the S&P 1500. This is a little confusing. I'm going to try to break it down. The S&P 1500 is broken down into the S&P 500, which is large caps, 600 small, 400 mid caps. You add that all together, it's 500 companies, okay? If you take the top, like the largest 10% of the 1500, you may as well just go down to company 150 in the S&P 500. That is Carrier, which is a $48 billion stock. In other words, if you have a company that you're investing in that has a more than $48 billion market cap, it's probably over here on the right side, where your effective interest rate is the red line on the bottom. So see that red line on the bottom there? How your effective interest rate basically hasn't gone up at all? You're pretty Gucci. The same is true for companies even in the middle 40%. The middle 40% is probably going to be somewhere between your $5 billion market cap to your $48 billion market cap. That's probably your mid-range right there. Those companies have seen an increase in their effective interest rate, but nowhere near as much as those lower or smaller companies, that light blue line. Basically, if your market cap of the company you're investing in is under $2 billion, there's a good chance you're getting reamed with higher interest rate expenses. And after all, this, by the way, and we're going to get to some conclusions here, especially what I think about this, but these, by the way, are the kind of perspectives that we like to think about in the course member live streams. Which, remember, if you're part of the course member live streams, you have access to them forever. For as long as I do course member live streams, which I've been doing them since like 2018, and I love doing them every single day, the market is open, you get to be part of them with me, ask me questions, throw Q&A at me, throw your situations at me, your stocks at me, we do the analysis together, you throw your real estate at me, we'll analyze it together. We have a lot of fun in them. So if you want to be part of the group who will get first dibs on House Hack, they might buy all of the shares. Last time they almost bought all of the shares. and this cycle we're limited by how much we can raise, then make sure you're part of the group. Be the first to know and first to qualify to invest in House Hack by being a course member. Yes, we have a coupon expiration. The reason the price goes up over time is because I keep adding more value and more content to these courses. I've got some course lecture releases coming within the next few days. We're going to be posting those, and those are always added for free for existing members. So there's really no reason not to join. Check that out by going to meetkevin.com. Email us if you'd like a bundle at staff@meetkevin.com. Okay, so what does all of this mean in terms of what society in general is telling us and the pain for the consumer? Well, the first thing that, in my opinion, it means is we have to be careful with consumer-exposed stocks. Unfortunately, a lot of things are consumer-exposed. So the best potential plays in this environment, and it sounds like a broken record, but you look at the companies that are beating, it's no surprise right now. The companies that are beating are companies like Salesforce, and that's because they have a lot of enterprise customers. The enterprise customers are the mega caps. So you almost want to be investing right now where the mega cap companies are spending money. So wherever the mega cap companies are spending money, that's where you want to go. If that's NVIDIA, if it's Salesforce, if it's Snowflake, if it's cybersecurity, although, there's some question about some of these because, even spend in cybersecurity has slowed down. These might end up being places to pay attention to, though. CrowdStrike has performed pretty well over the last few months. Certainly in 2023, you could look at another one like Cloudflare would be another option. They haven't performed as well as CrowdStrike, but also done decently well. And so what are companies that basically the big companies are spending money on? And maybe that's where you hide as a stock investor. So the consumer exposed side seems to be the most pained. However, the flip side then is, what happens when that flip-flops? What happens when the consumer ends up in a better place and interest rates start coming down? Okay, that could happen. But is it going to happen before something breaks? Well, this is where I kind of wrote down a cheat sheet. Here you go. In the hopium scenario, you hope that artificial intelligence spend, capital expenditures at big mega caps all increase at the same time as inflation goes away so the Fed can cut rates. That's your soft landing, your hopium scenario. The bad scenario is you run out of time, something breaks, and you end up with mass layoffs, which really kill the consumer before you end up, having the Fed step in to save the day, right? But by then, so much has already broken, you probably end up having more pain. This, I think, is why you're seeing the lowest wage increases at smaller companies. It's also why you're seeing the senior loan officer opinion survey show that banks' willingness to lend to small and large companies alike has plunged to recessionary lendings levels, but that's okay because the mega cap companies can easily issue their own bonds, so they don't actually have to rely on banks, whereas the smaller businesses do, and that just ends up killing the smaller businesses, which is usually where you are exposed to entertainment, hospitality, more local, small consumer spend stores. And this is where you really got to ask yourself, how much do you want to be exposed to the consumer, or are we at the point where it's time to buy the dip on the consumer? I'm not convinced that it's time personally to buy the dip on the consumer. I am convinced that there are opportunities that long-term will end up still winning, but I want to narrow my exposure to the consumer. For example, I think Tesla and Enphase, probably enough exposure to the consumer. Both of those stocks suffer if the consumer falters, which they kind of have been. The question is, have you passed the bottom yet? In the case of Enphase, are you at the bottom? Nobody knows. The question on the flip side then is, do you just hide in some of those enterprise-related hardware or software companies until the consumer definitely flips back to positive? So far, it doesn't seem like the consumer recovery is here yet. And that is flagging big red flags for some of these institutional analysts. And I'll tell you, the explanation that the mega caps are pulling everything up makes a lot of sense when you consider the weird perversion of the yield curve inversion actually helping the mega caps. Yes, the perversion of the inversion. I just said that. Anyway, let me know what you think about this. I'll leave a comment down below. Make sure to check out the programs on Building Your Wealth. Coupon expires tonight. We'll be traveling and responding to emails, so you can probably follow me on Instagram. I'll probably post some stories there, and we'll see you soon. Thank you so much, and happy birthday, Jack. He turns 8 today. See ya. Bye.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.